Chinese President Xi Jinping on Monday called on major world economies to spur growth by coordinating their programs as the world continues to pull itself out of the unrest caused by the coronavirus pandemic. In today's video, we'll discuss everything Xi Jinping had to say in his speech. But before that, make sure you press that red subscribe button along with that tiny bell icon to get updated every time we post new videos. Let's get started. In a virtual address to open the World Economic Forum's Davos agenda, the Chinese President Xi Jinping said that while global inflation dangers were coming up, policymakers should strengthen economic policy cooperation and develop programs to help the world economy from dipping again. We must do everything necessary to clear the shadow of the pandemic and boost economic and social recovery and development, he said. If major economies slam on the brakes or make major U-turns in their monetary policies, there will be serious negative spillovers. They would present challenges to global and economic financial stability, and developing countries would bear the brunt. Beijing's rearmost measures came as the country reported that its economy expanded 8.1% in 2021. While that number beat the government's own targets, growth decelerated to half that pace in the final quarter of the year and is anticipated to struggle once again because of COVID and an intensifying real estate extremity. Government economists in China have been advising of a spillover effect caused by the Fed's interest rate hikes. Of the major central banks, the Fed is anticipated to be the most aggressive, with fiscal markets now pricing in 4 rate hikes, and the US Central Bank is coincidentally anticipated to start reducing the size of its nearly $9 trillion balance sheets. Yields on the standard 10-year Treasury on Tuesday reached the loftiest position since January 2020. Traditionally, Fed officers brush off concerns about how their programs impact other economies, saying that they can only make financial policy for the US economy. Xi has reason to be nervous about Fed tightening. Despite tariffs that were started by President Donald Trump and continued under President Joe Biden, Americans are still aggressively buying Chinese products. Through November, China was the #1 source of imported goods at $463 billion, beating Mexico at $350 billion and Canada at $324 billion. China's economy continues to decelerate, falling to a 4% growth rate year on year in the fourth quarter from 4.9%. On Monday, the People's Bank of China cut 2 policy rates by 10 base points. The International Monetary Fund, meanwhile, has advised that suddenly tensing financial policy in the United States or Europe could beget economic turbulence in developing economies. The sentiment about economic growth and inflation has shifted in the United States, the IMF wrote, as prices rise at the fastest pace in nearly 4 decades. The economic recovery in the rising countries, meanwhile, hasn't been as robust, it said, adding that those places are defying substantially higher public debt. Faster Fed rate increases in response to inflation could rattle financial markets and tighten financial conditions around the world, the IMF said, also warning of decelerating demand and trade from the United States and its effects on developing economies which rely on exports to American consumers. Economists from the Fed wrote last June that the threat of spillover to arising markets depends on many factors, including conditions within those regions and how vulnerable and sensitive they are to high US rates. So that's all for today's video. Let us know your views in the comment section below. And don't forget to like this video before leaving. Thanks for watching.